Good afternoon, everyone. Welcome back after a short Easter break to our live webinar interviews. This is our fifth, and we are very excited to host someone that I know all too well, but that I will be interviewing today on a new capacity. I already see him smile. Hi, Claus. Claus Mansfeldt.
Hello. Hi. Good afternoon.
Claus Mansfeldt is the chairman of LPEA, but anyway, he's been ignoring all my calls in the last weeks in the context of LPEA, or almost all of them, because he's very busy running SwanCap, of which he's the chairman. And he'll tell us what SwanCap does, but it's both a fund of funds and a co-investment fund that's been around for quite a while. And this is why we invited you, Claus, today. So we have 10 minutes, just the two of us, while our audience listens in and can send additional questions. And after those 10 minutes are over, during which we'll cover 3 questions, we can open up to Q&A. So we'll see how long you'll be with us, because we have quite a few people registered today. And it's all about, of course, what's going on the GP and LP side of private equity, 1 month into confinement and the unfolding crisis. Claus, anything I should have added to this introduction?
Well, perhaps that, you know, when you say I've ignored you in the LPA capacity, it's actually a compliment. It's in the knowledge that it's in very, very good hands of yours already. So.
Oh, that's so kind. I think I'll invite you for a drink when this confinement is over. Claus, I have a lot of questions, but the 3 that we selected for you today are, what are, you have both the role of a GP and an LP, and what impressed me the most going through your fund documentation, also as an investor, is the fact that you have 100 relationships with GPs across Europe and the US. Tell us about these GPs. As their LP, how do you manage that? And also as a GP for a co-investment fund, what are you doing?
Okay, well, you know, 100 GPs, it's just an indication of the diversity that we have in our investment portfolios, which basically is kind of boring in the sense that it is so diversified that there's no major incidents visible on a daily basis. But that's obviously also a good thing in these times. So how do we manage as a GP? We have to basically, first of all, stay calm. We are lucky as an established PE house to, you know, to have an up and running portfolio, up and running commitments, long-term funds, and so on, like many of our members and colleagues in the industry. So in a way, you know, we are the lucky ones. We don't suffer some of the day-to-day gyrations that you have in public markets or even in open-ended funds. I mean, you know, closed-end funds, there are of course no redemptions as such, and less volatility, less drama. So it's not so difficult to be calm, but underneath that calmness, there is a lot of activity at the underlying fund level. So all these GPs are working extremely hard, and our job as a fund of fund is to try and stay on top of it, and you know, make sure that we understand what's going on there, and to then brief our own investors with additional information, reporting, and analysis and investor calls as best we can, in terms of trying to predict where this might lead in terms of valuations and perhaps cash flows. So that's sort of the GP side of things. And on the LP side, we want to make sure that we remain disciplined and deploy in, you know, at all times, quote unquote. So you know, one of the most important things with our business is to remain a steady deployer, not to exaggerate deployments in good times, and not to get too far behind the curve in downturns, when history has proven that returns can in fact turn out to be greater. So you know, that's really what we try to do, and we try also to capitalize a bit on opportunities, or to support our GPs or our co-investments if there are, you know, further add-on opportunities and so on. We can play with the underlying GP, and maybe there will be some interesting secondaries opportunities as well coming up, and then finally there might be some opportunities to get into some hard to get funds that one hasn't perhaps had full access to historically, but perhaps there will be some investors partly absent and opens windows. So those are some of the reflections as an LP and GP.
Thank you, Claus. You mentioned history. So I think back in 2008, you were still in London when you spent almost 30 years. You were running a portfolio. What was the impact back then on your portfolio of the global financial crisis? And how do you compare it to running SwanCap today? Although it was the same team, but different firm, right? Or different setup.
Yeah, no, that's right. So, the team has been doing this for about 20 years and independently in SwanCap since 2013. And back then in the previous crisis, the hypothesis behind the diversified portfolio kind of played out. So obviously it was correlated, it had a downturn, but our worst ever vintage has returned 1.3 times money, and we've just never had a down year, i.e., less than one times in terms of performance for a year. So that's all about diversification. We certainly had some lessons, and some of the lessons were what I alluded to earlier. Back then, I think we invested a bit too much in the run-up to the peak, and then we conversely retracted a bit too much in the downturn itself. And that has partly to do with where the business sat, because it sat within a bank, and banks have all kinds of different parallel motivations for the use of balance sheets. So that perhaps in the end wasn't optimal. That's also one of the reasons why we spun out eventually. Now, at the same time, we also had a direct investment business, which is effectively sponsorless, more merchant banking oriented. And that turned out to be, more difficult partly because it was structured minority interest usually, often in emerging Europe. Those two factors, for example, combined meant that we got very exposed very quickly during the crisis. So exits took much longer, and returns were much lower for this type of activity. So one of the big lessons from all this was to do basically try and do best in class private equity with the best managers in the best possible way, and the best possible way was to actually be an independent asset manager ourselves, focusing only on this type of business. So yeah.
Meanwhile, all the balance sheet activities in PE in banks disappeared since the crisis. So that's probably a proof in the pudding.
Yes, to a large degree. It sort of came back a bit again. There's always a temptation in banks and it's understandable, to try and to sort of cross-selling or capitalizing on the synergy between, say, leveraged finance activities and the analytics and the relationships with GPs you have there, by also participating in the equity, which was in fact the origin of our own activity back in 2000. But I think banks are, however, doing it a little bit differently this time. I think they're doing it more within asset management units with, segregated third-party money, etc. So I would say banks are still in the game, but they are probably in a more sensible setup this time.
Okay, so we have 2 minutes left for the last question before the Q&A. Again, for our viewers, you can see at the bottom of your screen a little window called Q&A, and that's where you can log in your questions. I already have 3 for you. It's a bit of a personal question, but so you were based in London 30 years, you've been in Luxembourg for 6-7 years. What is the difference being a PE investors there and here? And what would you tell people who don't know the place where we are today, Luxembourg?
Okay, well, London, is a metropolis. It's a hub and a global financial center. So that in itself is a big difference to Luxembourg, although Luxembourg is a significant financial center and very large in funds. But London is very much a transactions hub, and I think that colors life in every respect, professionally and otherwise. And so it's very much about doing the deals, raising the funds, and transacting. So you are really being spurred on to jump on that bandwagon and do as much as you can, because doing nothing is not necessarily so celebrated. The contrast with coming to Luxembourg is perhaps one where we found a little bit more calmer, where you have basically, and also in surrounding areas, I'm talking also DACH region, Benelux, etc., where continental Europe, where perhaps one has a slightly less frenzied deal-making culture, and a slightly longer term horizons, a little bit more risk averse potentially as well. So that's sort of the investment environment that I feel.
But surely you didn't stop doing deals coming to Luxembourg, so.
No, we certainly do deals, but we have hubs in Munich, Milan, New York, etc., where most of the deal making is kind of generated. So it certainly is possible, and from our point of view, being a fund-of-fund investor, it's a little bit different in the sense that we don't have to be right out there generating the underlying deal itself, but more about diligencing managers, etc.
Okay, and otherwise you're happy in Luxembourg?
Very happy in Luxembourg, and I think it's a wonderful thing to have experienced both, and try to bring both the transaction-oriented London to the table, as well as the slightly more risk-averse modesty of Luxembourg, and try to wear both hats when you look at a deal.
I always tell people who ask me that London is indeed transactional and Luxembourg is much more based on relationships, which then lead on to deals, but you can't jump to the deals right away. But we can discuss that longer. So I have 4 questions for you.
Yeah.
The first one is, so you mentioned this comparison 2008 to now. Do you think the PE industry is better equipped today than it was at the GFC time to weather the storm, if any, that will ensue COVID-19? And it's the first time in this interview that we say the word COVID-19, so I'm happy.
Yeah, I think we have perhaps a generation of practitioners that have been through that particular crisis, that are now partners and managing the firms coming into this one. We have certainly noticed a lot more prudence in the transactions assumed in the run-up to this crisis. So already building in recession cases, multiple contractions on exit, anti-cyclical or non-cyclical investment given priority, etc. So I think there's a lot of lessons were learned and have been applied in the run-up. Now, that's not to say that this crisis will insulate private equity from a downturn and a valuation contraction on average. But again, I think the chances are very good that it'll be less than the public market contraction as per historic performance.
But I mean, I don't like the idea of averaging out PE. So what do you think are the strategies that are going to win out of this, or the sectors or the geographies? Can we say such thing? And maybe if we expand, I know it's not in your scope to do venture, but if you look at across the board.
Yeah, no. Okay, so some of the winners we're seeing right now are elements, obviously, of healthcare that plays to perhaps the solution to this particular pandemic, but also slightly more broadly. This will continue to be an investment area that will find a lot of support and a lot of ultimate business. So healthcare was already our best performing sector, and I think it's likely that it'll continue. The other one is a bit exemplified by this very interview, is remote communications, business services, cloud-based enterprise software. types businesses. Those are also likely to, we're already well performing and are likely to be doing well. We have not been particularly invested in retail or travel and so on, which will, at least physical retail will suffer. Those who are ahead in e-commerce might do well, but travel is obviously a pretty difficult area where we have not been investing anyway for a long time. So, those are some sectors, countries. That's really hard to say. I think we try not to be overly exposed in any given country, and that's how we basically approach it.
Okay. Any word on like growth versus buyout, debt and venture?
Yeah, I mean, buyout is historically the area where we have most experience as a firm, and where we feel most comfortable. We are seeing now in the one weakness perhaps of buyouts, or the strength is, of course, you're buying already successful and established businesses with cash generative revenues, etc. So these types of businesses look good from the outset, but of course we add leverage in the leverage buyout, and they have a bit more debt than, say, the similar company would have in the public sphere. So that's the issue. But debt in itself is not something to be feared if you can pay it. And of course, this is carefully analyzed from the beginning. And we have found that in our portfolio that in any event, we are below the average of the industry. And now you have covenant light situations as well. So that won't necessarily be a major issue for a long period of time. So I think this LBOs will continue to do well. As far as debt is concerned, perhaps there will be a certain sort of margin expansion or yield expansion right now, which means prices of debt that's on the book might go down, which is tricky. But I still think private debt funds will weather the storm well, because they're typically invested with some of the best and leading buyouts anyway. And then on the venture side, I think it's probably very bifurcated between the ones who are larger and established and funded, and the ones who are venture and where the manager is a venture him or herself, right? So they are really, so those are perhaps the most exposed, the youngest VC firms. Yeah.
Claus, 3 more questions, so we're gonna have to be short. Although it's fascinating, you have to give me a number. What is your expected NAV drop for the next 2 quarters in private equity as a whole?
15%.
Good. Okay. We will remind you of it in 6 months. And I have 2 more questions. So you're the president of LPEA, and I'm asked if what do you see for the local PE sector? The impact is going to be long and short term of this crisis. Positive, negative?
I think it's pretty much neutral to the crisis, in the sense that none of the components that make Luxembourg attractive as a domicile for private equity funds and for practitioners and administrators, none of those components have become less attractive. If anything, perhaps, as governments continue to print money to shore up the crisis and credit ratings might fall around the world, Luxembourg obviously has a fantastic starting point, AAA starting point, which will be hard to shake, or at least in relative terms, likely to be supportive. So, and that gives comfort. Just an example, of course, at a very high level. The other aspect is, there is not so much volatility here in terms of Luxembourg's exposure to the changes in valuations of the private equity sector. There's also a huge administration center, and
it's
that's
like a hedge, huh?
That's kind of a good thing. I mean, you know, as we joked before the meeting, and to paraphrase Gordon Gekko of the Wall Street movie, you know, funds never sleep. So they still need to be accounted for. They still need administration. They still need audits. They still need all the good things and valuations and so on. So they need all the good services that are provided at a very high level here in Luxembourg, and that's probably a comforting aspect.
Trust us for quoting you on this one in the next newsletter. I think we have to wrap up, but we will have you back to comment on this. And I know we're issuing some opinion papers from LPEA to our members. And speaking of which, Claus, can you, what do you have a message for our member community? You have a chance now to speak to many, and also for those who can't attend, as you know, we have this YouTube channel, LPEA, where they can replay all the interviews we had so far. So tell us the message from the top, please.
No, those are great initiatives, and I think it's very important to stay in touch, you know, as we are physically removed from each other, and this is a great example of one way of doing that. And I encourage everybody to do so and to reach out if they want to have calls with any of us, and certainly encourage you to do so with your friends. And we have to apologize that some of our networking events have had to be postponed, but a thought came to mind, Raja, that as we plan for the next season, maybe we could include a sort of end of COVID masquerade ball to celebrate.
See, that's why I thought I miss you. I haven't seen you this long ever. Yeah, it's over a month now. So what kind of masquerade do you imagine?
Well, I think you can imagine what I'm thinking. What kind of masks might be appropriate for that party?
We have some ideas actually, and we may show them for the first time at the AGM, which may be partially real, partially virtual on the 10th of June. So thank you, Claus. Stay close to your portfolio, and see you soon again on these waves, whether they're real or digital.
Absolutely. Thank you very much.
Thank you, everybody.